Hello and welcome to Money Matters. The Hong Kong stock market has plunged to levels not seen in 7 years. Struggling investors may despair of the losses, but our two stock pickers go head-to-head, bargain hunting while prices are so enticingly low.
The market weakened further, so Daniel So and Patrick Yu returned to a head-to-head rematch this month. Daniel's first choice is green energy player China Longyuan Power, stock code 916, a leading wind power generator in China. Daniel says the company has a couple of positives in the overall energy outlook. The first is the sudden surge in the price of oil as a result of the shock invasion of Ukraine by Vladimir Putin's Russia. The grinding slowness of the Russian campaign in the face of stiff Ukrainian resistance has not calmed energy markets searching for a clear endgame in the war. The hefty increase in fossil fuel costs forces power companies like Longyuan to pour more clean green energy into the generation mix.
What we learned from the Russia and Ukraine crisis is that it's important to diversify energy source to reduce reliance on energy imports. And from China's perspective, believe they would continue to push for development of new energy and also carbon reduction. And this sector has always been a beneficiary sector from a policy point of view.
Another catalyst that would spur the shares higher is the possibility of Longyuan's state-owned parent company, China Energy Investment, would inject more assets into the company. That would up its wind power capacity, enabling it to generate and sell more electricity into the power grid system, boosting earnings growth. Net profit for 2021 rose 35%, and the company seems on track to continue on this path, barring more shocks out of the Ukraine or the pandemic closer to home. The risk to the outlook could be a slowdown in the transfer of state aid, pushing for greener power and lower carbon emissions.
These kind of companies have been receiving subsidies from the government, but in the past, some subsidies have not been paid in cash yet. That have become some receivables. So investors have already priced in some of these risks that they have received subsidies, but in the cash flow, they haven't benefited so much, as much as they would have liked.
Daniel says his target price is around the peak of last year at $20, and he sets a stop loss at $14.30. Daniel's second stock choice is infant formula maker China Feihe, stock code 6186. Daniel likes Feihe because of its dirt-cheap valuation that sank to greater bargain levels after the last sell-off a week ago. The company also has a very stable earnings outlook.
Now that the market sentiment is really weak, but for the dairy product industry in China, the demand over the past few quarters or currently should be relatively stable. The earnings outlook, despite the weak macro environment.
Investors have fretted over the rising level of input costs in the consumer staple food sector. But Daniel says baby formula ingredients from the dairy industry have not seen the same price hikes as those in other sectors like beer makers, which have suffered from sharp wheat price rises as a result of the Ukraine war. Expect some new earnings growth drivers in the next few quarters.
The company is actively developing business in children and adult milk powder products, in addition to existing infant milk powders. So that would give the company more growth drivers going forward. And it is really cheap. It's now trading at around 7 times PE in current year estimates, compared to its historical average of 17 times.
The company faces a long-term risk if the already low Chinese birth rate drops further, reducing demand for its core product.
One of the risks is the birth rate in China may be hit by the current COVID. So that would directly affect the demand of infant milk products over the next 1 or 2 years if COVID lasts for longer.
Daniel sets a target price of $9.50 and a stop loss of $7.10. Joining us again is investment veteran Patrick Yu, who chooses the Alamo of mainland defense stocks, China Mobile. The company has slipped gently into mega bargain territory during the recent sell-off. It has a solid subscriber base, and with a yield edging up to 7%, the stock is a financial pillbox.
I think the earnings of the China Mobile is not affected by the global economy, and that's why the earnings for the China Mobile is much more stable. As a result, it can continue to distribute a very stable dividend yield. At the current price, it is trading at around more than 6% dividend yield, and I think that it is much more attractive for the long-term investor.
As the company's user base lives and works in China, its defensive nature is nearly impervious to global risks like Russian tanks and artillery. In the present low sentiment, Patrick says he'd buy a chunk of stock if the price sank below the $50 per share level. He says minor adjustments in the subscriber base are inevitable. User churn may spike as subscribers look to switch providers in the hunt for the best 5G deal in the market. But the main prize here is the dividend in the current very low price. Patrick sets a target price of $56 and a stop loss of $46. For his second choice, Patrick returns to an old favorite, another safe place to ride out the volatility in global markets roiled by uncertainty. Shipping company OOIL, stock code 316.
It will report the earnings by the end of this month. And I'm still very confident that it will report a very good result because the freight rate in 2021, especially in the fourth quarter, is very, very good. And I think that it will distribute a very attractive dividend to the investor.
Patrick says the payout ratio will continue to be generous, and at a PE of 3 times, the company is a streaming bargain. Aside from the war in Ukraine and increases in environmental scrutiny on the shipping industry in Europe, he says there's very little risk running with the stock long term. OOIL's strong defensiveness has prevented it from suffering along with the tech and internet stock meltdown in the recent HSI slump. He sets a target price of $240 and a stop loss of $180. We'll review Daniel and Patrick's choices in 1 month to see who comes back to go head-to-head. Heavy selling pressure on the local stock market was relieved by policymakers in Beijing, who vowed to put a floor under sectors caught in regulatory crackdowns. Top Beijing economic policymakers called on government agencies to issue policies that are favorable to the market. That lifted sentiment here. Stocks recovered from lows not seen since 2008. The surge was a reprieve from recent heavy selling of Chinese tech companies and other pressures related to the war in Ukraine that had taken the Hang Seng Index to new lows. Yum China, the owner of KFC, Taco Bell, and Pizza Hut restaurants in China, says it may have to delist from the New York Stock Exchange by 2024. The remark came after U.S. authorities said the company had failed to provide access to audit documents. Yum China's Hong Kong-listed shares tanked 10% after closing 11% lower in New York. Washington is demanding complete access to the books of U.S.-listed Chinese companies, but Beijing bars foreign inspection of working papers from local accounting firms. Goldman Sachs and JP Morgan Chase became the first big American banks to wind down business in Russia after Moscow's invasion of Ukraine. The moves will likely increase pressure on rival lenders to follow suit. Both banks said they have limited credit exposure in Russia. They plan to use the coming weeks to close out pre-existing business relationships. Earlier, Citigroup said it would sell its retail banking business and close its investment banking operations. Unlike companies who make goods that ship to Russia, banks have loans, deposits, and existing customer relationships that take time to wind down or sell off. The sanctions have begun to bite ordinary Russians. Bank customers lined up outside branches trying to withdraw or convert as much cash as possible, even as the buying power of the ruble plunges to unheard-of lows. The exodus of Japanese companies from Russia also picked up steam. Uniqlo owner Fast Retailing said it would continue operating its 50 stores in Russia because clothing is a necessity of life. But it made a U-turn soon after, saying it could not continue business due to a number of difficulties. Japan Tobacco, which controls about 1/3 of Russia's tobacco market, said it would stop investment, marketing, and the launch of vaping products. Shiseido has suspended exports of its cosmetics, while Sony and Nintendo halted deliveries of their gaming consoles.
Coming up on Money Matters, how toys are a barometer for global trade. Stay with us. Welcome back to Money Matters. The Toy Fair returned to London after last year's event was cancelled due to the pandemic. But as supply chain issues continue and manufacturing costs rise, industry experts predict toy prices will rise as well.
It's playtime again. Last year's London Toy Fair was shut down due to coronavirus restrictions, but this year, more than 260 companies are showing off their latest products at the fair. The Toy Fair first launched in 1954, making this the 68th edition. The return of the physical fair was greeted with gusto as thousands of people and customers showed up to see what's in play and what to play with. For the event's organizers, it's a relief to get the toys back out of the COVID-imposed box.
It's better than Christmas being at the Toy Fair. We missed it so much last year. It's really important for small and medium-sized companies particularly. You need to touch and look at toys, to see them, physically handle them, look at them, ask questions. It's really important for innovation. It's really important for ideas. But it's also important for meeting your customers, the retailers in this case, or e-tailers.
It's been a roller coaster couple of years for the industry. Toy sales in 2021 were actually down on the previous year by 3%. But that's because 2020 was a bit of a boom, as people were stuck at home for long periods of time, looking for things to purchase online. 2021 is up 2% on 2019, the last pre-pandemic year. The challenges in 2022 are likely to be supply chain problems and rising manufacturing costs. Many worry that could lead to a measure of sticker shock on retailers' store shelves.
It may mean there are some small price rises that I would expect that there probably would be if you're thinking about prices, but toys are a pretty inexpensive item compared with other major purchases. I mean, on average, the average price of a toy is probably about £10, something like that, so it's not a major investment item.
Licensed toys, or toys based on popular movies and TV shows, are a huge part of the market, accounting for around 28% of sales. The pandemic saw the release of many Hollywood blockbusters delayed. But this year, new installments in franchises like Batman, Spider-Man, and Jurassic Park will be released, so it's expected to be a bumper year for related licensed toys. However, 21st century children aren't just interested in big screen playthings. The internet is now fueling the must-have products, such as the YouTube channel CoComelon. U.S. manufacturer Just Play has a licensing agreement to produce toys for the online series. Its Learning Adventure Bus has been named as one of the fair's best toys this year. Online-derived content will form an ever greater portion of the future for the toy industry.
You know, traditionally, historically, TV programming was where kids were exposed to new programs, new characters, and new content. Now TV is still a place to find it, But online is where the kids are seeing most of their things. With YouTube is hugely, hugely popular. And you'll see millions and millions of views of episodes of something like CoComelon on YouTube, which can be portable. It's on an iPad, it's on a phone, it can be on a terrestrial television through a smart TV. It's just so much more accessible for the parent to provide the child with that content.
And partnerships with household names like Disney are crucial to Just Play's business success. But like most manufacturers, it faces rising costs due to supply chain issues and more expensive raw materials.
As you hear in the media, everything's going up, whether it's food or energy. Unfortunately, the price of toys will also go up. And that's, as I say, through the raw materials, through the cost of the shipping. And yes, it will translate to consumer pricing. The reality is the products that we're buying or the cost of manufacturing is higher than it was. So we need to pass that cost on, otherwise we're not in business.
It's a familiar story repeated by almost every toy maker. Rachel Simpson-Jones, editor of Toy World magazine, says there's room for optimism.
So the toy industry is incredibly resilient. It's actually about 2% up on 2019, despite a little bit of a decrease last year, which was to be expected with the pandemic and the impact of shipping, a lack of lorry drivers. The great thing about the toy industry is that children are always going to have birthdays. There are always going to be special events to celebrate. Of course, there's always going to be Christmas. Toys really are a year-round gift.
Simpson-Jones says trade fairs are absolutely vital to the toy industry, and that she has heard again and again from customers and vendors that people really wanted the trade fair to come back, as the remote mode of sales in the pandemic era didn't bring in enough business.
And deals really take place. You speak to the exhibitors here, you speak to the visitors here, people are opening new accounts, they're meeting new retailers, they're forming business partnerships. It's not just for show, this is an essential networking event.
One new business hoping to make some profitable connections is Northern Ireland-based toy company, Mr. Hullabaloo. Run by two former teachers, it began life as an educational business, visiting schools to do storytelling workshops. It launched a toy and learning resource range in 2020, just as the pandemic hit.
During the pandemic, we had the challenges with when we ordered. Some of the materials were made in the Far East, and obviously China went into several strict lockdowns. That led to a delay because shipping from overseas can take up to 16 weeks. With us, that ended up translating into, I would say, closer to 9 months to a year, which has been very difficult for us as a small company.
The company has plans to expand outside Northern Ireland. Kells says that physically coming to the fair to meet new contacts helps achieve its plans.
I would say the business benefit is making contacts and not knowing when you're talking to people, you don't know where they're from or you don't know who they know. So if they see the same potential in it that we can and other people can, well, they might just have those right connections to help us.
So, from the big manufacturing giants to small businesses just starting, the Toy Fair aims to cover all the bases. A glass-blowing business based in Kenya has been providing employment to locals for 30 years. Having survived the economic hit from the pandemic, Anselm's Kitengela Hot Glass acts as a school for glass blowing, as well as inviting visitors to watch the artisans at work. For over 30 years, the company has continued to practice its unique craft of glass blowing while offering employment opportunities to over 70 people. The business focuses on recycling clear and green glass to make fine glassware, handmade blown glass, and jewelry. Located on the edge of Nairobi National Park, the company is a popular tourist destination.
This is not my first time here at Kitengela. I come quite often. I love spending time here. The product is absolutely amazing. I love the fact that everything's recycled. It's just brilliant here.
The company says everything in the glass studio is crafted with strict adherence to its sustainability pledge of leaving nothing to waste. Founder Anselm Croze describes glassblowing as an old but special craft that is skill-heavy and requires deep concentration. Croze says it is cheaper to make glass products from recycled glass as opposed to new raw materials.
If you recycle glass, it's cheaper than actually making glass from scratch because you only have to melt it. You don't actually have to make the glass from sand and soda ash. Glass in the environment is actually not particularly dangerous. It's very inert. In fact, it's extremely inert, and eventually it defaults to sand. So if you smash up bits of old bottles, you can use them as building sand or in roads as a sort of aggregate.
The pandemic presented many challenges as the number of customers declined, and so did sales. However, the company managed to keep its doors open against all odds. 23-year-old Elizabeth Simiyu is the first female trainee. She says she found the craft of glass blowing very fascinating, triggering her need to learn the craft. She is also learning from experienced craftsmen like William Gitonga, a 35-year-old father of 4 who has been in the business for a decade.
From my background of humble beginnings, I've been able to raise a family from this kind of job, and I'm very happy about it.
He says it'll take Simiyu about 5 years to get a handle on the craft, long enough to see the end of the pandemic perhaps, and maybe a revival of the company's income.
That's the show. Thanks for watching. Next time on Money Matters, how commercial landlords in Wan Chai North have adjusted rents to suit the times. See you then. Good night.